Hey everyone, Anthony Venuti here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode, and thank you for clicking. On this episode, we're going to be talking about lenders. What's the difference between some of the products? What's the difference for the rates? And most importantly, what should you be considering if you're going out there to renew your mortgage or even refinance and or purchase a new home? Stay tuned, you don't want to miss this. I wanted to start off this episode by having a conversation about obviously rates, clients, and things to consider when getting into a mortgage. And it's very important because we got a call last week from a client who was in need to restructure their existing mortgage. Life had happened. The spouse had basically gone on mat leave. Then they ended up having pretty much 2 kids back to back. And, they incurred some debt. The problem is that we could not actually get them out of the mortgage because they were in a 5-year fixed, and the mortgage product that they had selected would not allow them to actually get out and refinance. And if they did, they would have had to stay with the existing lender, and the rates that were being offered to them were substantially higher. So they were hand-tied to that lender. The other option for them was to basically sell the home, bona fide sales clause. And the clients were never explained this. They were very upset, obviously, because whoever had administered that mortgage, originated that mortgage, did not really disclose that to them. And it happens more often than we'd like to think. A lot of clients are blinded by their rates, and they're blinded by, the exact amount that it's better than this product because it's cheaper. And that is obviously with a mortgage a big myth. Even though the rate might be substantially better, you always have to look at the trade-off. Now, these clients obviously didn't probably think that they would have been in this situation 3 years from the day that they signed that mortgage. Most clients don't think outside of the, within the 5-year term, I should say. And they say about 65% of Canadians actually don't make it to the 5-year mark. So selecting the right product that is versatile and gives you the ability to maneuver yourself, even with a fixed rate or a variable rate mortgage, is very important. And I advised the clients, I said, look, at the time, we looked at the rates that were happening, maybe it was about $15 more per month if they would have selected a better product that was more flexible. And it got us thinking to some conversations that we want to have with our clients to sort of dissect some of the products that are out there, especially when you're looking at different mortgage products. And obviously in this time frame right now, I know a lot of people may not be thinking about purchasing a home, but they may be considering restructuring, or maybe they're coming up for renewal and they're shopping around for a mortgage and they're trying to make heads or tails of it. And our basic warning message to clients is, yes, rate is important, but make sure that you're understanding the product itself. If everyone else in the market is offering a specific rate and these products are significantly lower, what is the trade-off to you, and what is your long-term structure or your long-term financial goals with that property, selling, refinancing, restructuring, so on and so forth. So I think it's important to get on, and we'll start covering some of the different products, sort of do like a refresher course for some of our clients who are looking to engage into the market, as there are some differences in a lot of the products, and sort of maybe debunk some myths along the way. And obviously at the end of the video, we're going to give you some things to consider if you're renewing or going out there to get a mortgage, and maybe some questions that you should be asking your advisor, your mortgage professional, or your bank. The first product I think it's important to talk about are insured mortgages. And insured mortgages are basically one where there is a default insurance premium added because you're purchasing with less than 20% down. So basically the maximum amortization for these products, 25 years. You cannot exceed 25 years. You can do less, but you cannot go over 25. And the max purchase price for these products is at $1 million. Currently, you cannot exceed $1 million. And obviously the insurance premium is paid by the client, and that is paid on the addition of the mortgage. So basically it's added back to your mortgage. And then on closing, you would be paying your provincial sales tax, your PST. And it can range, the premium can range anywhere from 2.8 to 4%, depending on the size of the down payment. If you're at 5% at the entry level, or you're upwards of 19.99%, just below 20%. And the rates are obviously the lowest for this particular type of product. And why are they cheaper for insured mortgages with less down? I always get this question. And it's very important to understand that this mortgage, although the riskiest for any lender, it is insured by one of the major 3 insurers in Canada, Sagan, Canada Guarantee, and the big boy CMHC. So these mortgages are basically, as a liability to the lender, they're insured, sent back, and come back as an asset, because if you default on that mortgage, the bank is not responsible for covering that. They pay the default insurance premium, or they pay their deductible, so to speak, and that mortgage is written off and taken off their books. And as far as exceptions, when it comes to ratios, obviously credit is very important. Credit is important for any particular mortgage, but obviously with insured mortgages, there are lender criteria. Anywhere from 620 to 680 and above is generally where you want to be, depending on the lender. And obviously that will impact your rate and the amount of money that you can basically borrow. When we talk about exceptions, it has to fit within the box of the bank's guidelines, and rates can start anywhere from 4.49 as of today for a 5-year fixed, and around 3.70 for a variable. And these are generally, depending on the lenders that you're working with, very, very good products. Now, there are some lenders that may offer some slightly better rates, but you're going to be trading off many different components within that product. And as we talked about, and we'll mention later on, what things to pay attention to when you're looking at your lenders. Now, when we look at insurable mortgages are like insured mortgages. However, the major difference is that you, the consumer, will not be paying the insurance premium. So let's take a look at this right now. The minimum down payment, as opposed to the insured mortgage, is 20%. You have to put 20% down in order to gain an insurable mortgage at an aggressive rate. The maximum amortization for this product is also 25 years or less. And once again, the maximum purchase price is $1 million. Now, rather than, as I mentioned, the client paying the insurance default premium added back to the mortgage, the lender would now basically cover that on their end, which means you don't pay anything for that insurance premium, and you get a little bit more of an aggressive rate. And obviously, the rates can range significantly with some of these products based on the down payment. Now, if you're putting down anywhere above 35%, you're going to get the lowest rate when you consider insured mortgages. So you're still starting at that 4.49 all the way up to 4.89, for example, or 7.9 as of today, depending on that down payment. And that's crucial to understand. A lot of clients will ask us saying, well, why is it different between the down payment? Now, it is important to understand that between the insured and insurable, they all have the same criteria in regards to the purchase amounts, the credit scores. Everything has to fit the box, and there's no room for deviation when it comes to servicing ratio. So the income, credit, everything has to be spot on in order to fit within this model. And lastly, we'll look at what is called or considered a conventional mortgage. And generally, this is where a lot of people may not understand the differences between the products. So a conventional mortgage is obviously 20% down. Like an insurable mortgage, it's still 20% down. However, when you can put 20% down, you have the ability to opt to a 30-year amortization. You don't have to take a 25, which for some clients may allow them to stretch out their ratios a little bit. And obviously, controversially, yes, stretch out their ability to purchase for just a little bit more. And basically, there is no cap on the purchase price, right? So this is where the conventional mortgage is very, very important. Now, you don't have to take on, you can buy a home for more than $1 million and still, if you qualify, take on a 25-year amortization. But the moment you basically go over the $1 million mark and you put 20%, you have an option as a consumer to select between the actual amortization and qualification. With conventional mortgages, generally though, if it's over $1 million, yes, you're going to need to have 20%. And depending on the size of the purchase, if it's a significant amount, some lenders may have what is called a sliding scale. So if it surpasses, let's say $1.6 or $1.8 million purchase, you may be required to put additional funds down. And obviously, no default insurance, no premiums. However, the rates are a little bit higher when it comes to a conventional 30-year mortgage. And that is because the lenders at the current moment cannot insure those mortgages or back-end insure those mortgages. And basically, they have to keep these types of mortgages on their balance sheet. And for the lender to keep that on their balance sheet and not be able to, insure it, it comes at a premium. So rather than pay a premium or the lender pay a premium, they add it to the rate. And generally, this is still very aggressive rates in this particular, scenario. And the better part is that, let's say, for example, you're trying to stretch that budget. You are basically still working within the lender's guidelines, but there is room for deviation when we talk about servicing ratios. That is important to understand. Now, we're going to dive in to a scenario just to explain to clients to see exactly how each product is different and sort of what the costs are on an average purchase. If we look at the scenario, obviously I said average purchase, and then all depends on where you're buying. Obviously, if you're purchasing homes outside of, Toronto or Vancouver, you might not be hitting this particular price point, but it's important to isolate when you look at, let's say, an $800,000 purchase and you look at insured, insurable, and conventional products, you'll see how each product is a little bit different or similar depending on what you're looking at. So the mortgage itself is on an insured product, putting down the bare bones of a minimum down payment of $45,000. Now, why $45,000? Anthony, you said you can get in with 5%. That is correct. However, you have to understand anything over the $500,000 benchmark is 10% in addition. So basically, in this particular case, it's $25,000 on the first 500 and then $20,000 for the additional 700, right? The $200,000. And that leaves the amortization at 25 years. And here you'll see the insurance premium that is added back by putting only 5% down. That is the most insurance premium you're going to pay. It's 4%. And that's $30,200, making the mortgage a total of $785,200. It is basically increased. Now, the total income required to qualify for this insured product is $178,000, and the consumer would have to have zero debt in order to fit that particular guideline. And the payment itself, obviously very high at $4,297.98. And you see how we qualified it, obviously at 4.39 plus the twos at 6.39. Sliding over to the insurable part of the actual scenario, and you look and say, okay, you bought for 800, you put down 20%, that's 160, you have a $640,000 mortgage. And yes, you can still opt for the 25-year, no insurance premium added to the consumer. And basically you would need only $155,000 with no debt. Now I say only because these numbers are basically combined household incomes. And obviously if you're far below that, it is a different scenario. But I mean, we're looking at the numbers for this particular purchase price. And obviously that payment will bring you to $36,1014. And you can see how with only 20% down, they don't get the better 4.39, because if they put 35% down, they probably would. But basically you're looking at 4.69 plus 2, qualifying at 6.69%. Now let's shift over to the conventional side and just look at some of the differences between insurable and conventional. And when you look at this type of product, you'll see that they're pretty much spot on. 640, 160, around $160,000 down. That's exactly 20%. The difference is that this client can now select a 30-year amortization. No insurance premium. The income required is around $149,000, but there is room for deviation in that if it's within a couple $1,000, there might be some ability to get this approved, as opposed to this deal here on the insurable side where it needs to fit those guidelines. And obviously the payment is a little bit lower, $3,566.06. It is a tad bit lower than the 25-year, and that's because you're extending the mortgage by 5 years. By extending the mortgage by 5 years from 25 to 30, you're basically giving yourself a little bit of breathing room in that actual payment. Now, it's important to understand, yes, we're qualifying a little bit higher. So even though the rate is higher, the payment is lower because of the 5-year addition. And this is very important to look at. Now, a lot of clients will say, well, yes, if you take a 25-year and the rate's lower, more money goes towards principal than towards interest, which is 100% true. And we're not talking about clients that fit all these buckets and can actually, jump between them. A lot of clients will need to qualify higher. Maybe their income isn't as significant. Maybe they're not looking for a $700,000 mortgage or a $640,000 mortgage, and understanding how to play within those fields. But basically for some clients, that additional savings between even the interest rate, even though it's a bit higher, they're actually looking at their monthly cost of that additional savings, and they're not looking at the 30-year run of the mortgage. Now, whether you agree or disagree with people's thought process on how they approach their mortgages, everybody's individual. Some people will look to pay down their mortgage much more quickly and take the shorter amortization route. Some clients may choose to take a longer amortization route, and how things operate with them. So those are definitely just some scenarios to give you a little bit of a snapshot into how we look at insured, insurable, and conventional mortgages. Now, as I mentioned, we're basically going to end the video off by talking about some things that you would need to consider if you're planning on getting out there and either getting a mortgage, whether it be a purchase or refinance, you're looking to renew, there is definitely a lot of things that you need to consider. And some of the things I've just basically done a couple of bullet points of things that I would advise our clients, or things that we talk to our clients about very openly and transparently when we're talking about products, because we always get the question, Anthony, what's the best rate, right? And I'll say, well, what's your credit score? What's your down payment? What's the equity in the home? What are you looking for out of the mortgage? Are you looking for, something that you're going to stay in there for 5, 10, 15 years? What is your financial goals? Where is the journey taking you on this home? Because those questions will help guide what product and what type of lender you should be working with. You shouldn't be fitting the client into the lender. It should be the lender fitting the client. It should be the product fitting the client's needs. A lot of times we hear this is that client themselves, and they try to fit them into the lender, right? It should be the other way. We should be taking the client's wants and needs and then finding a lender or finding a product that meets their needs, because that's more important. And yes, as I mentioned earlier on in the video, a lot of clients might say, oh, but that's $20 cheaper per month. And I say, yeah, you're right, 100%. But think about that as an insurance premium on the fact that if you take some of these products that are more open, you can refinance if you need to. You can exit that mortgage, whether you like it or not. We had a client a while back who had basically gone to a fixed rate mortgage. I advised them strongly to take one of our monoline banks. And basically, unfortunately, we got a phone call from them a few years later, and they were unfortunately separating. But basically, because they yielded our advice and took a product with a monoline with a lower interest rate differential, even though they paid a substantial amount, it was about $10,000 cheaper than it would have been with a top tier bank. And because of the fact that they didn't take on some of the discounted products, they were actually saving money. And although they didn't foresee that, and nobody does, they were actually coming out on top, because even though they were paying an extra $15 or $20 more a month, they saved $10,000 in their penalty that it would have been comparable to most other banks. So when we talk about things to consider, these are some of the things that you should be looking for. Higher or lower penalties on fixed rate mortgages. That is point number one, right? If you're looking at your conventional banks versus some of the broker friendly banks that we have access to, some of them will calculate their interest rate differential much differently than your conventional bank, saving you some money. You will be paying a penalty, but at least you can exit the mortgage with a penalty, and that penalty will be much cheaper than any other bank, especially the top 6 that you're looking at, because they use a posted rate to calculate penalties, and posted rates are definitely elevated as opposed to some of these other banks that do not have a posted rate. They use their current contract rates. And then obviously looking for conditions like bona fide sale clauses, meaning that in order to get out of this mortgage, there's only one way: sell the home, right? So you have to look for that. A lot of clients don't understand that, and it's sometimes too late by the time they figure it's there, or they're either at the lawyers or they're signing at their branch. Calculations on 3 months penalties for variable rate products. This is a big one. And a lot of times when we're looking at these particular products, sometimes they'll offer these significant discount on that variable. And I look at those contracts as sometimes, we'll get lenders and we'll send off a deal just to get some clients some options. And then we'll look at it and we'll see within that contract, it's as if the client breaks within the first year, it's this amount of money. If the client breaks in the second year, it's this amount. And it's not just a straight 3-month penalty, right? So that ends up costing the client a little bit more money if, for example, rates change and the client decides that they want to get out of that product and move into a different variable, or maybe get out of that product entirely and not have to port that mortgage over. Because remember, in this current environment, if rates are high, right, and you basically take on a mortgage, and let's say in 3 years from now you decide to move or sell or restructure that mortgage, whatever the case is, if you're looking to port to a new property, are you going to want to take that rate with you, right? You have to be prepared for that. Just because the rate is good today and you can port it, if the rate's 5%, and then let's say in 3 years from now rates are back to 3.5% or 4%, and that's a 1% savings, you're not going to want to port that mortgage over. You're going to want to try to get out into the cheaper mortgage, depending on the numbers, if the numbers make sense. So that's important to understand, and I think I'll touch upon that in just a little bit. Adjustable or rate mortgages or static mortgages. Obviously, this has been a big topic here on the channel. Is the mortgage a variable product? Is it adjustable or is it variable? And are you okay with having static payments, or are you okay with having your payments change every single month or every single time the Bank of Canada makes a rate announcement and the lender changes the prime? And obviously, there are no refinance capabilities. Some lenders will keep you tied in. You won't be able to refinance that product or get out of that product. They may offer you adding a second mortgage to the property, but you want to be able to know that you can actually restructure that mortgage, even if it's with that lender, right? You want to know that you have that ability to do that. And we talked earlier about portability of the mortgage, where you want to be able to know if that mortgage is even portable. Can you take that mortgage and switch it over to the other property? Now, an important caveat for portable transferability and portability of mortgages, I know those terms are obviously sometimes interchanged, but we're talking strictly about portability, means taking it from one property to the next. It's very important for clients to understand, and we get this question a lot, if you're porting a mortgage over, you still have to requalify at the time of the port. So just because you have a mortgage that was approved for X amount when you got it, and you're buying it on this new property and it's less or more, and you need basically a blend and extend or a blend and decrease or top up, whatever it is that you need on the new mortgage, you still have to requalify with the bank at that particular time. So it's important to understand that, because if you qualified then, you may not qualify now, and it's very important to understand that. And obviously, another big thing for clients is prepayment options. A lot of times, some of these no-frills lenders that are offering these heavy discounts don't give you the ability to make a huge prepayment. It might only be 5%, and some lenders may offer you 10, 15, or even 20% prepayment privileges. So it all depends on what your comfort level is. And obviously, the other component is some lenders, some banks, depending on where you're working, they may not offer accelerated payments. So you may be able to do monthly, or you might be able to do like semi-monthly. You might be able to do biweekly, but you may not be able to do accelerated. Now, accelerated mortgages obviously mean that if you're looking at it, let's say on a biweekly structure, let's say you're looking at 12 months, instead of making it 12 payments, you can make it either 24 payments, or you can do 26 payments. So an additional 2 payments means it's an accelerated mortgage, and we can probably do another episode or have a refresher on that down the road. But I basically want to leave the video here and having this conversation with our consumers, talking about insurable mortgages, conventional mortgages, what's the difference between insured, insurable, and conventional, and obviously looking at things that you need to consider as a consumer going out into the marketplace, trying to find the best product that fits you and your family. So as I mentioned, we'll leave the video here, wishing everyone a great Friday and an even better weekend ahead. Thank you again for tuning in, and until next week, stay tuned.